Beyond Meat? More like Beyond Mistake. The company is down 79% in the last year. Just in 1 year, the company's lost about 80% of its value, and in the last 2 years, it's lost 90% of its value. Over a 5-year time period, it's about the same, but if you go back to its all-time high, right after it IPO'd in 2019, this company actually reached the $200 range. And versus where we're at today, at a whopping share price of just $13.78, you see that this company has come a long way down, and I mean a long way down from its previous all-time high. And there's a lot of good things happening with this company. They're rolling out new products, which they've done heavily in 2022, like the new Beyond Meat steak tips. Those are really good. Or what about the new Beyond Meat jerky? I've actually been dying to try this. I've seen this at Walmart. I've actually been wanting to try it. And then what about the new Beyond Meat chicken? The new breaded tenders that are strictly made from plant-based products with 50% less saturated fat. And now the company is targeting positive free cash flow in the back half of 2023. So all things are looking rosy. Things are looking good in terms of the company's reporting, but why is the stock price down? Why is this company went down 80% this year and 90% over the last 2 years? We're going to talk about that in this video. While it may look good, while it may look rosy, and you might be looking at the stock price thinking, okay, it's went down to $15, now's the time to buy. Well, I'm not so sure, because we're going to talk about the good, the bad, and the ugly with Beyond Meat in this video, so stay tuned, it's going to be a fun one. Let's go ahead and get started by looking at the top line revenue growth. But before we get into all that, we have to talk about today's sponsor, MooMoo. MooMoo is a new up-and-coming brokerage that is taking the world by storm. Commission-free trading, level 2 data, advanced technical indicators, earnings calendars to see the date of financial statement releases, and institutional tracking to follow Warren Buffett's portfolio are just a few examples of what MooMoo has to offer. With this being my first sponsor in the channel, I have fully vetted their company and stand behind their vision. MooMoo currently trades on the NASDAQ under ticker symbol FUTU for FUTU and is SIPC insured. If you sign up below using my special referral link, you can get anywhere from 1, 10, or even as high as 20 stocks for signing up when you use my special referral link down below in the description or in the pinned comment down below. Free stock amounts can be as high as $1,000, so sign up now using the link in the description or pinned comment down below. You would help support me and my channel by doing so and give yourself an edge in the world of investing. Thank you so much, MooMoo, for sponsoring this video. Now back to the content. Okay, we're back, and we're going to start by showing you what a top-line revenue growth chart should look like. It should be continually higher and higher per quarter, per year. Every single year, the company gets better and better revenue. And you see this across the board with companies that I invest in, like Salesforce, like Amazon. You see continual revenue grow and expand every single quarter and every calendar year, which makes the company, in turn, over time more profitable. With Beyond Meat, we saw that for a long time. If you look at the annual charts, the revenue growth was impeccable, and that's what originally got me interested in this company. 2016, we have $16 million in revenue. The next year, it doubles to $32 million. It over doubles again in 2019. It over 3x's again from $87 million up to $300 million. It goes from $300 to $400 million, up to $464 million, and then now we look where we're at today, and we look at some of the most recent quarters, and not only is the company not growing, but it's actually shrunk. If you look at the two most recent quarters, if you look at the July quarter, it was $149 million last year. This year, 147. That's not growth, that's actually about a 1% decline. And then what about this quarter? This is when it really starts to get ugly. For the quarter ending October, you can see that it had $106 million in last year's. This year, $82 million. And then the profitability has not been good as well. But we're going to talk about more on that in just a second. The company has been trying to grow its top line revenue by expanding into new products. The new steak tips are brand new to their line. They just announced these, as well as the chicken tenders. Both of these are brand new to their products line. Personally, I haven't even seen these in stores yet, and I hadn't seen the jerky, been out for a while now. Maybe if I had to guess, roughly 6 months in my Walmart or so, if I just had to guess. I've seen those on the aisles at my local Walmart, and they have been driving sales from this, and they're trying to make up for the lack of revenue growth with new inventive products. And that's great. There's nothing wrong with that. I see that as a positive. It's good to see that the company is actually expanding into new product lines, and they're now forecasting positive free cash flow in the second half of 2023. And so you might be looking at this and you might be saying, Jordan, okay, this company right now is under $1 billion market cap. This company is still doing hundreds of millions of dollars in revenue, and they're projecting that profits are going to be here in 1 year, less than 1 year actually. And so you might be saying, why would I not be buying the stock now? They're likely going to get back to growth with these new products. They're likely going to be putting up positive free cash flow based on their estimates. And then we get to the truth. And the cold hard truth is this. Let's go to this Piper Sandler research data that I pulled up not too long ago. And it's funny because you see two highlighted in red here. You see all different types of data. And there was one that I originally had here, and it was about Crocs. Because Crocs is a holding that I own that's done very well. We originally bought our position this year at $76 in the midst of the recession. And even despite today's drop, we're still up on our position at $92. So we're still up about 20% or so. So it's actually been one of my best performers this year for a boring old shoe company like Crocs, because children across the board all over the country, no matter the gender, no matter the income level, Crocs and Hey Dude both, which are obviously owned by the same company, are getting more and more popular, as Crocs ranked number 6 last year, and now it's number 5 this year in terms of its popularity in shoe wear. And now Hey Dude was originally ranked number 9, now it's ranked number 7. It moved up 2 in the ranks, so now in the top 10 we have Crocs and Hey Dude as the top 10. You notice on the second red line that I have highlighted though, teens plan to eat less plant-based meat. Of the 14% of teens that do consume plant-based meat, 23% of teens plan to eat less plant-based meat, up from 17% in fall of 2021. Now this is shocking to me. This is not something I saw at all, because I thought the plant-based trend was going in the right direction, and it seems that it's not at all. And this is what you can see from the top line revenue growth in real time. And this leads me to why I believe this company will not be free cash flow positive. The one way that you get a company of this size to reach massive profitability is scale. If you look at all the big names in food, why do you have just a couple of companies pretty much dominate all the food and drink space? Let's look at Pepsi. This company has a multi-decade track record of growing top-line revenues from producing profitable products and then using that to buy out other products. And they produce about $80 billion in revenue a year. And actually after this year, it'll probably be somewhere around $85 billion with all the growth that they've had. What about companies like Hershey? Hershey is a company that practically dominates the little candy bar market, and they're doing massive amounts of revenue. You can see that they're doing $9 billion in revenue for just candy bars. You get the point. It doesn't matter if we're looking at Hershey. It doesn't matter if we're looking at Pepsi. It doesn't matter if we're looking at Tyson Chicken. The real players, the people who actually make real profits, not just funny money, not fake revenues that transition into losses, but real money that hits bottom line, comes from the big players who puts up tens of billions of dollars in revenue. And right now, Beyond Meat is not that player. And so for them to get to that level, they need massive revenue growth. These type of numbers we saw over the last 5 years growing at a compounded annual growth rate of 95%, almost doubling revenue every single year on a 5-year track record. That's what we need to see. 400 million in revenue ain't gonna cut it. Less than 500 million in revenue ain't going to cut it. To be honest, anything that's not in the billions is likely never going to produce real profits. So guess what? When you look at these numbers, you see the general trend of free cash flow going into the negative. And honestly, the funny thing is when you look at this, which direction over time does it seem to be going to you? Does it seem to be improving? Normally what you see is negative free cash flow that improves. Let me give you an example of this. A company I used to be an investor in, and one of the biggest losses I've ever had, was Chewy. Now Chewy was a company that, in my opinion, did not put up positive free cash flow the way I wanted it to. But you can see they had big losses over here, and then they shrunk the losses, and now they're putting up little bitty amounts of positive free cash flow. Now they're actually putting up positive numbers and making profits. It improved over time. But if you look at a company like Beyond Meat, it's not doing that. It's not getting better over time. The losses are going in the complete opposite direction. They have actually grown each calendar year. 28 million in losses, 33 million in losses, 61 million in losses, 72 million in losses, $100 million in losses, and then last year's $437 million in losses. You see that they literally had 464 million in revenue, 437 in losses. Those are negative profit margins of almost 100%. One of the worst I've ever seen. And this doesn't even tack on share-based compensation. They do have a small amount as well where they have to pay the people that actually run the business. They pay tens of millions of dollars for share-based compensation. And you can see that shares, generally speaking, go up over time as they award those to high-up executives in the business. So you get diluted a small amount every year as well. So Beyond Meat, in my opinion, is not something that's impressive, not something you want to invest in, and something that I honestly hear that they say that they'll be cash flow positive in 2023, and I think it's a joke. Honestly, this is the type of company I consider shorting. If this company were to run up in price to say $20, $25, $30, this is a potential short for me, not a long play. So in my opinion, I'm avoiding Beyond Meat like the plague. There's also been issues with management, and I didn't even get into that because this video would be too long. But even with this company going down to $13 and change, down another 5.75% today, I think it's just getting started. And I hate to say it, but now we're getting to a chance where Beyond Meat might eventually, in the next couple of years, might even reach zero. Because one of the most impressive parts of all of this is how fast this company burns capital. If you look at their debt pile, you see that they've had to raise billions of dollars. And if you look at their cash, it's one of the saddest stories ever. The moment that they raised this huge cash pile last year, just a year and a half ago, it's almost all gone. Millions, or I should say hundreds of millions, is gone every single quarter. And just that huge debt raise that they did a year and a half ago, well, about 60% of it's gone already in a year and a half, and they'll have to raise debt or share issuances just within the next year if they want to stay alive. So thank you guys so much for watching. I appreciate you watching all the way to the end. Check out all the stuff down below in the description, including MooMoo for sponsoring this video. Thank you guys for sponsoring it. But other than that, guys, thank you all for watching, and I'll catch you guys next time.